Hello, this is Doug Gerlach, the founder and editor-in-chief of the SmallCap Informer stock newsletter, welcoming all of you subscribers to our mid-year 2020 subscriber update webinar. Today is June 30th, 2020. It's hard to believe that the 2020 year is half over, or we can always look at it the other way. It's half yet to go, and probably the most interesting part of the year will remains to be seen in the next 6 months. But we're going to talk about where we are in the market and the small cap stock environment. We're going to answer your questions as best we can, and thank you once again for being a subscriber to our small cap newsletter. Now, before we begin, let's review some of our tips for those of you who may be new to our webinar format. Now is a good time to make sure that your headphones or speakers are plugged in and the volume is turned up on those devices. And the GoToWebinar tool I will point you towards if you need assistance. If you're having trouble with your audio, you can use their wizard to help resolve those issues. If the graphics or audios drops out of the presentation at any point, make sure that you've not running a program on your computer that might be interfering with the transmission of the video and the audio. Don't connect using Wi-Fi if you can help it, because a hardwired connection will be more reliable. And remember that you can listen using the telephone with the instructions in the webinar email that you received. That will free up your computer to deliver the graphic portion of the program. If you need more help, contact GoToWebinar directly on their website or via the telephone. And we've got Russell and Sean standing by in the back office who can help if you are having persistent issues. Now, you can use that questions box, which may look something like this, to type in your questions at any point. We'll do our best to address those as we can. The handout is available in PDF format for the slides that we're going to take a look at today. And there are two versions of it. One is 2 per page in full color, and the other is 4 per page in black and white. So you can pick which version works best for you. Some people, when they want to print it, don't want to print the full color version, but the full color version is more legible than the grayscale black and white version. It's also larger than the grayscale black and white version. So pick and choose whichever one you prefer. That's why there are 2 versions there in the handouts tab. So I'd like to welcome you again, remind you I am the president of iClub Central, which is a wholly owned subsidiary of Better Investing, and we are the publishers of the Small Cap Informer stock newsletter. I edit that newsletter as well as the Investor Advisory Service newsletter, which is a 10-time recipient of the Holbert Newsletter Honor Roll. I also oversee the products that we develop for investment clubs and individual investors, and I've written books and I present all the time across the country at various conferences. The small cap stock universe is really my passion. I enjoy working on the small cap informer and making the stock selections, doing the write-up, and educating people about the importance of adding that small cap exposure to your portfolios. Let's take a look right away at the small cap market performance, how small caps have been performing in the market year to date. And if we look at it since the beginning of 2020, we look at the small section of the market as represented by the S&P Small Cap 600, the large segment of the market as represented by the S&P 500, and I like to look at the large cap international market from the developed world, the EFA index. So the S&P 500 year to date is down just 5.2%. The EFA index is down 11.78%, and small caps are picking up the rear at negative 19.4% for the year to date. Now on this graph, you can see the close correlation in March as all segments of the markets started to fall around the world as the COVID-19 pandemic began to arrive. In late March, things bottomed out and all of the major indexes started to move back up again. The drivers for the market recovery remain somewhat a mystery. Everyone is aware of the severity of the market and the coming recession. I think we all understand that. But the markets being what the markets are, investors are going to respond as they respond. Things were looking pretty dire in March, but if you were able and steel-nerved enough to make purchases in the third, fourth week of March as we ended into April, those selections have probably performed pretty well for the last couple of months. From my perspective, there are really three key factors that are driving the market as we look at things from the long-term, mid-term, and short-term perspective. In the long term, there's been a massive shift over the last 20 years towards indexing and ETFs. And I think this is providing a lot of support for equities, especially large cap stocks. There's a lot of money that's in these index funds that's being held in retirement plans where the account holders are not trading them. They're just sitting on that money over the long term. And the more that indexing becomes popular, the more stability is going to be available for the holders of those large company stocks within those ETFs and index funds. That's my position. The data certainly suggests that index funds and ETFs are continuing to grow throughout the different market and economic cycles. In the midterm, so in the 1 to 5 year range, the TINA effect is still in place. That is, there is no alternative to stocks. With interest rates being as low as they are, investors don't need to be worried about bonds. It's a non-starter. Investors are not sitting on cash in large amounts because it's just not earning anything in those savings accounts or even in certificates of deposit. So investors are keeping their money in the stock market because that's the only place they perceive they can achieve returns. And in the short term, I think what's driving a lot of the recent market performance is the federal intervention, both from the stimulus packages that have been passed, that are available from state and federal governments that support individuals and businesses, as well as the Fed's policy of keeping interest rates low, lowering those interest rates, making lots of capital available, and now stepping into purchasing corporate bonds from large cap stocks in the United States. And those are some pretty significant drivers of the short term. All of that's set to expire, however, so in July, we would expect to see debate about whether the Fed will jump in with more stimulus to support the economy, because the economy is not going to recover overnight. This being an election year, it's typical in an election year for the federal government to be doing a whole lot to support business and to support individuals, to be throwing money at them, tax breaks, etc. This is an unusual election year because of the pandemic and the fact that we're heading into a recession, and because of the incredibly divisive state of American politics. So all bets are off, but there is an expectation that more stimulus is going to be provided, and that's going to help prop up the businesses and the individuals who are out of work and keep the big chunks of the market going. And that's not to say that we don't have issues with, there have been more bankruptcies this year, large bankruptcies, large company bankruptcies than we've had in any period since 2009. So coming after the last recession and the financial markets downturn. So we know that a lot of companies are struggling. We know that a lot of businesses are going to be filing for bankruptcy and shutting down. Often it's the case where these companies, a company like JCPenney files for bankruptcy, and I think a lot of the response that people have is, how did JCPenney last this long without filing for bankruptcy? They just don't seem very relevant to our economy in 2020 with all the alternatives that people have for shopping. Who's going to shopping malls anymore? Shopping centers are a different creature altogether. So there's still a lot to be seen with what's happening in the markets for the rest of the year. There is also a preference for large cap stocks that I think we can divine out of the current performance of large caps. Since 2015, pretty much large caps have been outperforming small caps on a fairly regular basis. When that's the case over the long period of time, investors who may not be as savvy because they're used to keeping some of their money in cash, but they're sticking with the blue chip large cap stocks, and they're earning outsized returns, so they don't have to look to the smaller section of company size, to the small caps in the market to deliver higher rates of return that will help their portfolios to perform. They're grabbing all the performance from the large cap stocks. At the start of the year, the average PE of Apple, Amazon, Microsoft, Google, and Facebook, sort of a modified FANG, I guess we'd call it, collection of stocks, but the average PE was 39.5, and that is very, very high for companies that are not growing much beyond the low double digits on an annualized rate. But investors love these companies, and so the more that investors love them, the higher the price goes, even if it's in excess of what the fundamentals might suggest. So we've got investors preferring large cap stocks over small cap stocks, and so that's certainly not helping the performance of small caps as a whole. Even while small company stocks are performing well, large cap stocks have been getting all of the glory. If you look at the last 20 years, the Russell 2000 outperformed the S&P 500 in 13 of those years, but most of it has been prior to 2015. So we're into the secular stage where large caps are outperforming small caps. And 2020 is, again, likely to see large caps perform better than small caps. That would be par for the course during this stage of the economic cycle. When we see recessions tend to affect smaller companies a little more severely than larger companies. Larger companies will weather the trends, weather the recession, weather the downturn with a little bit more ease than small company stocks. So I wouldn't expect that trend to turn around. Now, however, things get reversed coming out of bear markets, coming out of recessions. Small company stocks often tend to lead because they're a little more nimble. They can respond to ramping up production a little more quickly when economic trends dictate and suggest that might be a good plan. So meanwhile, we'll kind of stay the course and focus on the long-term potential of small company stocks in the market. Here's the 20-year comparison of the returns of the S&P Small Cap 600 and the S&P 500. And the small cap stocks outperformed large caps on the aggregate more than 3 times in that 20-year period there. So so that is what we like to keep our eye on, that long-term performance as we are moving ahead and thinking about where we're going in the future. When that leads us into a discussion of the small cap informer performance, how has the newsletter been performing? The newsletter is in its 8th year, so we do have quite a bit of data. We do track the performance of the stocks that we recommend until they're discontinued from coverage. We do keep track of the dividends. That's a small contributor to the performance. But here is a graph, a chart of the small cap informer compound annual return for various periods compared to the S&P Small Cap 600 index. So the blue is the Small Cap Informer, the green is the S&P Small Cap 600. Year to date, our picks are down at a CAR of 25.2%, while the Small Cap 600 is down 34.7%. So again, we're well ahead of the Small Cap 600, even in a down year. Now, our lifetime compound annual return is 4%, where the S&P Small Cap 600's annualized rate of return in that same period is down 6%. So you can also see in 1 year ending December 31st, 2019. That's not 2020. That should be 2019. Is I'm going to make that change right here. There we go. And the 1 year, the 3 years, and 5 years ending December 31st, 2019. You can see that the newsletter has handily outperformed the indexes. So from our perspective, this is good. Our objective is to outperform the small cap indexes. So we believe, and furthermore, I've written about this in the newsletter, our objective is to outperform. We prefer the S&P 600 as the index because it truly represents small company stocks. The Russell 2000, the way that it's composed, includes stocks with market caps as high as $9 billion, which we would not consider to be a small or barely a mid-sized stock by most definitions. So we'll acknowledge readily that the small cap informer return doesn't beat the overall market. But it's still our belief that we're helping to find those companies that fit into the small cap allocation that most investors should be considering for their overall portfolio. And over time, portfolios that have that diversification by company size will have the best risk-reward characteristics of that will allow them to have better returns and lower risk overall when you combine a large cap and a small cap performance. I just wanted to jump back, add one more comment that the last 5 years, as I mentioned, large caps have been outperforming small caps. So the fact that we've been way ahead of the indexes on the small cap side, I think is something that that I'm proud of. I think that we're doing what we set out to do. We'd like to improve our returns, and we're going to be working on some ways that we can perhaps be a little more active on the sell side, or a little more active on protecting from sudden downturns, to managing the volatility of the small company stocks. I think that's something that one of the lessons that we're learning, that we want to be long-term focused, but often the rest of the market is looking at small caps and judging them more harshly in the near term. So I think that that is definitely something that we want to be taking a look at as we go ahead. And if you do have any questions, if you do have questions, please use that questions box. Otherwise, I'm going to keep plowing ahead, talking about what's ahead from for the stocks and the economy for the rest of 2020 and beyond. And remember, our focus is always looking out half a decade into the future. So now we're thinking 2024, 2025. Where's the market and the economy going to be by those time frames? We're not trying to market time the direction of any company or any market segment in the near term. We're really focused on trying to find the best opportunities right now and remain fully invested in stocks. So what happens between now and 2022, 2023, we're not so concerned about. If we have a recession, if it lasts for 4 quarters or 6 quarters, or maybe even a little longer, that'll take us into 2021, 2022 timeframe. And then we would expect to see that expansion kicking in, which will help lift small company stocks as well as large company stocks. As you look at 2020, it's pretty clear that the US, as well as many regions of the world, are in a recession. A recession is defined as 2 consecutive quarters of declining GDP. This is the end of the second quarter. The first quarter was definitely down. We expect that the second quarter is going to be down, and all estimates at this point indicate that yes, we are going to have the official declaration of a recession coming sometime in the next couple of weeks. The COVID-19 remains a significant problem largely due at this point to the mixed response at different state levels to the pandemic. And I think this is going to likely extend the recession. The states that acted quickly and very deliberately early on are now seeing that drop off. They're still not fully reopened out of an abundance of caution, but that's saving lives, and it's going to make the rebound all the better when it does come. But it's likely the case that we're going to have a new normal that will drive drive American business, drive social interaction throughout the country. Companies are going to have to reconfigure to reduce person-to-person contact, take other measures to protect their workers, protect their customers. And if you just think about the widespread implications, you'll see the measures that many states and localities are taking right now to decrease the congestion, to decrease the interaction between large groups of people. You know, what's ahead for your typical bar and grill, to me, remains a big picture. I mean, some people may not be concerned about it, but what's going to happen to the nightclub industry? It's hard to conceive at this point what those might look like in a post-COVID new normal world. Yes, if we do get a vaccine, that might make all the difference, but we could be looking still at years of behavior remodification to eliminate or reduce the chance of transmission of the virus from person to person. So that's just a few comments on where we stand. I think it's difficult, makes it very difficult for us to predict. I'm counting on 3 to 5 quarters of recession based on how quickly the recession and the economy in the U.S. has responded to past recessions. And you know, I'm leaning towards a little bit longer than the typical recession, just because of the complexities of COVID-19 layered on top of people who are unemployed, companies that aren't spending, and the jolts to the economy that are going to undertake. There's a lot of talk about the V-shaped recovery. There's a chance that might still happen. I'm beginning to think that we may see more of a U-shaped recovery, where the bottom gets a little bit wider before we see that full-scale economic recovery ahead. And that's, you know, again, it's just very difficult to see, but I've been basing our investing model when we're looking at companies on what does that V-shaped recovery model look like. And there's a wide range of estimated results for different companies. Right now, we just don't have a whole lot of information that's going to help us make the most optimal investing decisions about individual equities. As I mentioned, small caps are going to likely lag large caps until this recession ends, until the pandemic resolves one way or the other. The next batch of quarterly company reports will start coming in late July, and that's going to be also important for us to kind of get a sense of how businesses are performing and how the markets will be reacting to that business performance. And so we're going to definitely keep our eyes on those quarterly reports as they're coming in. The target keeps moving, so it's good for us to maintain focus. What's going to happen to individual companies that may be up in the air, but we're going to continue to monitor them. As I look at companies, as I've been reviewing the companies in our portfolio and looking at other companies, I've been putting things into boxes, and that's helping me to understand how those companies are likely to respond to what's still to come down the pike. And one of them is the box of companies who are most affected by the pandemic. Generally, these companies are already considered cyclical or economically sensitive in nature, which means that during a recession, these are the kinds of the companies where we see pullbacks, we see earnings fall offs, maybe even earnings losses. That's all just normal. When we have a recession, people tend, for instance, not to travel as much. So travel companies decline. When we have a recession, companies don't make big capital equipment investments in large, construction equipment, for instance. So we would see those companies to fall off. So right now, these companies, because of the pandemic, there's just no knowing how or when these companies will resolve or whether they're going to be forced into bankruptcy. When I look at hotels, airlines, cruise lines, casual dining restaurants, retail, real estate, entertainment companies, and of course, energy stocks. Energy was being hammered by a whole different set of factors before the COVID-19 even arrived. These definitely have the highest risk and require nerves of steel to invest in those companies at this point. It really remains to be seen if the major cruise lines and the major airlines, how well they will be able to hold up until people start traveling again, people willing to travel again, government regulations allowing people to travel again. So these companies require patience if you are investing or holding those companies, and carefully monitoring the uncertain circumstances as news becomes available, digesting it, interpreting it. So I'm not at all saying stay away from airline stocks or airplane stocks or stay away from hotels or cruise lines, but you have to understand that there are forces at play here that make this a little bit more speculative than it would otherwise be. So that box, for me, I'm not willing to go too far into it, although certainly Air Lease is a company that we follow. I think the leasing business is a little bit different than operating an airline. So I think that there's enough of a difference there to differentiate it, that I'm happy to sit on my Air Lease stock and sit on it in the newsletter. Casual dining, different from fast food. Fast food, in the current issue, we updated on Meritage Hospitality Group, which is the small company out of Michigan that operates Wendy's restaurants, and they were able to keep open almost all of their Wendy's stores because they were able to close the dining room, but they were still open for drive-through and takeout. And so, yes, that diminishes sales. People were not as willing to leave the house, but at the same time, Wendy's had just started offering breakfast. So this was something new, something different. And so they were able to navigate, but it's very different if you're not geared up, a restaurant that you're not geared up for casual dining. And BJ's is a restaurant chain that I thought had a lot of potential, and they just got hammered by the market over the years, and it just became clear to me that the pace of recovery for BJ's was longer than I was willing to wait, and they became victim to COVID-19 in terms of, at least in terms of our coverage, and we just continued covering them. We just didn't feel like they were going to be able to pull it out over the long term. Or, well, let me restate that. I'm confident they're able to rebound. The question is that what's the time frame? How long is it going to take? If it's going to be 2.5 years in the future, that's too long to wait. And so I just didn't see that it was worth hanging on to that company when there were other opportunities there. Real estate is a little bit, depending on what the real estate is. Grocery store landlords are fine. They're receiving 100% of the rent. Other specialty retail landlords, store landlords are not so good. Retail real estate is pretty tough. Operators of shopping centers and shopping malls, those companies have been hit very hard. Hard to see when people are going to feel like heading back to the mall. on a regular basis. So that is just some examples there. Certainly the entertainment industry. Disney is an entertainment company. Disney was one of the most widely bought stocks by our investment club customers in the weeks following the pandemic. And Disney is an operator of theme parks that are still shut down. The Disney Plus service, their movie distribution, so much of that business is not happening right now. And this is one of the big victims of the pandemic, in my view, and it's going to take a long time before we start to see growth again from Disney, especially from their theme park and hotels. That whole operation is essentially shut down. The next bucket or box of stocks is the economically sensitive stock. These are stocks that you typically see most affected by economic slowdowns, and they're not going to be rebounding until the recession ends and the economy hits the next expansion mode. Typically, these are cyclical and sensitive super sector stocks and industries, including heavy equipment, banks and financials, real estate in general, basic materials, industrials, technology, consumer, cyclical companies. These are high-risk stocks, but the market doesn't always discount these stocks during contractions of the economy because they understand that, yeah, things are going to be bad for a time, but they'll come back around again. So as long as we're in recession mode, these types of companies traditionally you shouldn't expect a lot of performance from these particular companies. Again, some of it will have to do directly with pandemic COVID-19, but others is just driven by the overall economy. Defensive stocks are those companies that are most likely to hold steady during a recession. If you're looking at the super sector, there's a super sector called defensive, which includes healthcare, utilities, and consumer defensive companies. All of those we would expect to hold up. Grocery stores, drugstores, discount stores, and fast food restaurants. I consider fast food to be consumer defensive as opposed to consumer cyclical because people will, during hard times, they may not go to a casual dining place like Applebee's or TGI Fridays, but they will go to Taco Bell or McDonald's or Wendy's or any of the other fast food outlets or the new generation of fast burger outlets. And so I think that those companies tend to be performing pretty well right now. The problem is that they're performing well, so it can be difficult to find them at reasonable prices. So the return is moderate, but the risk is much lower. Amongst the consumer defensive, the recent performance of Ollie's, I'll call out. They had performed very well in their first quarter, which included the pandemic. They pivoted to include a selection of more essential goods. They already were carrying foods, prepared foods, canned foods, etc. So they pivoted to get more what they consider essential items in their store. And we're seeing people who didn't usually shop at Ollie's coming into Ollie's, and actually performance was pretty good for the company. They've been struggling last year a little bit over expansion problems. They had taken on some former Toys R Us locations and were bringing them in. They're expanding geographically into new regions, which require building up their distribution systems. They were now needed a whole lot more inventory, which on the one hand, they had more buying power, so they were able to negotiate some better deals. On the other hand, the simple quantity of goods they require to stock these new stores, they've got 330 or so some stores in place right now, takes a lot of resources. So I like the performance of it. The valuation is off the hook though. It's so pricey right now because it's one of those few companies that's delivered some positive news in the wake of all this all of this uncertainty. So those defensive stocks can be good, but it can be hard to find them at good prices. Another box are the surprise winners. Some companies and industries have been performing really well, often contrary to their typical sensitivity to the economic cycles. Many large cap brand name companies are doing really well. A company like Lululemon that we don't cover, but is covered by the Investor Advisory Service, has been performing very well. Maker of yoga clothing, just purchased yesterday a business that provides at-home workouts, so workouts you can do in your home. Nike, again, covered by our Investor Advisory Service, just a big brand name that no one's worried about shutting down, and people will always be looking for Nike gear. In particular industries, the housing segment has confounded a lot of experts by performing well. Housing starts and housing sales, new housing sales continue to be pretty robust. And the housing news for May came out last month, or yesterday rather, and the starts were better than anybody really expected. Part of this is being driven, I think, by the pandemic, where people are perhaps thinking, let's move away from this congested area to a bigger house with a bigger yard where we don't feel so hemmed in by all of these people who might be asymptomatic carriers of COVID-19, right? So psychologically, it feels like an escape. And that's, I think that's helping the housing business. It's certainly helping the RV business. Winnebago, which we track, has been one of the best performers this year. Their towable segment is a little soft, but RVs are through the roof. People are not willing to fly for vacation, and the thought of staying in a hotel or even renting a cottage, because you don't know who's been in that cottage before you or how well it's been cleaned, seems to make people a little nervous. So if you have your own RV where it's all under your control, you take your house where you want to go, when you want to go, and it's all for you, is really attractive to a lot of people, and especially younger people who are missing their vacations. They're missing the chance to get away from it all, and they're the new generation that is learning that these RVs are really not just for old people. So Winnebago had a great quarter as well, and a lot of positive demand for RVs. Certainly online services, technology companies, communication companies. Technology and communications tend to underperform during recessions, but of course this is an unusual recession, and so we're seeing a lot of support for those kinds of companies. Those companies, if you can find them at good prices, can be pretty good right now. Most of them will offer moderate reward at moderate levels of risk when you can find them. So if you're stock picking for the rest of the year, I would caution you not to underestimate the impact of COVID-19. Keep in mind the long-term potential of the stocks that you're buying, and keep a close watch on companies. As they release their quarterly reports, you can kind of get a sense of how well they're performing. Very, very, very few companies that I've been following have mentioned anything about the outlook for their second quarter, for instance. Occasionally, I get a glimpse. I can figure out a glimpse of what they're expecting as you read through their conference call and their earnings report press release. But by and large, we're in a holding pattern, I think, trying to navigate as best we can. And that's really all that we can ask for as we are looking for the best possible performers. So if you have some questions, let me take a look at some of the questions now. And Scott says, if the US corporate growth rate slows, would you anticipate investors to gravitate towards smaller companies that are still showing higher growth rates? Yeah, I would. That would be my expectation, that if investors can't get the return from large company stocks, and I think what's going to happen is large caps are going to, are going to see their valuations peak relative to their fundamentals at some point, and a lot of investors and analysts are going to be thinking, well, if you buy Amazon at this PE, how much return can you actually earn from it? But if you look at some of these smaller companies where there's opportunity, that's how the market shifts during the expansion mode, when all of a sudden these small companies start putting up terrific quarters. Investors are going to start paying attention to them. Joe asks, what's my opinion of using stop loss orders to protect from the downside or a potential downturn? That's something that I've talked about in past webinars. I've talked about it in the newsletter occasionally, suggesting that here's a stock that looks especially overvalued. We'd appreciate, I think if you have embedded capital gains here, you might look to protect them by using a trailing stop loss order. I've taught at the Better Investing Convention. I've taught a couple of times a class on trailing stop loss orders. We're looking at doing the calculations to potentially be able to present or have a reference on the website for all the stocks that we follow, what our suggested trailing stop loss range might be. I don't believe in using stop market or stop limit orders essentially, but a trailing stop loss where you set it at a percentage below the high that's reached, because we've got stocks that just want to keep finding new highs. And I think that a TSLO works a little better at allowing you to capture gains, to let your winners run, while catching you on the downside if we have a quick turnaround where the market turns 5, 6, 8%, whatever that figure is. And there's a method where you can look through a stock's history over the past year, for instance, and find what's the largest short-term turn the stock took. What's that percentage? And then you can translate that to something that makes sense in the terms of setting a TSLO that would be X percentage below the high price that a stock might reach. The problem right now, of course, is that we've got March 2020, where we saw stocks would have blown through any trailing stop loss on their way down. So the average range deviation from the high to the low in a short-term period is going to be very high. So we need to do a little more calculating. So that's what I'm thinking about, where we started working. As I said, I think that's an important area. And if you have thoughts on it, please reach out to me if you think that would be useful. I know we want to be focused on the long term, but I think we also need to protect what's happening in the short term as best we can. Okay, let's talk now. I wanted to mention on the SmallCap Informer website, we did launch discussion forums last month. So you need to log in with your subscriber ID, then click on the forum link, which is in the menu there, and you'll see the questions, or you'll see the discussions that are going on. So here is a subscriber who asked a question about biospecifics technology, a series of questions, and so I posted a response there, some additional information. So this is an alternative to using our support or reaching out to me directly. And again, if you have ideas for stocks or insights that you'd like to offer, this is a resource where we can communicate a little more effectively in a small knit community, all kind of focused on the same objectives. So that's the new feature that we've released in the last couple of months. I want to talk about our top small cap stocks for 2020. This is the special report. We did it in 2019. We also did it for 2020, where at the end of January, I published the 10 companies that I thought had the best potential for 2020 based on our stock studies and our projected total return. It's available. You can reach out and on the SCI website in the subscriber section, there's a link to download that PDF, so you can do it. Here we are halfway through the year. How has it performed? And as you might expect, here's the price as of January 24th and the price as of June 26th. And you can see one stock, Biospecifics Technology, has outperformed, and the rest are all showing negative returns so far year to date. Century Communities down to 6%, which is pretty close to even, all things considered, after having a good day yesterday. When you look at these companies, we can break them out into a couple different boxes. Once again, I'm trying to organize my thinking. On the left here, we have the stocks that I think are in a holding pattern for now. Air Lease, which is the leasing company for airlines. Again, I'm not worried about the small dividend they pay. I'm not worried about their capital requirements. They have plenty of capital. I'm not really worried about non-payment, that the leases are not going to get paid. There may be some deferrals. I'm not worried about Boeing 737 MAX orders. Boeing yesterday launched the first test flight of the updated Boeing 737 MAX with engineers from Boeing and federal inspectors on board. Things like, so that there's some forward progress there. I'm not worried about any of those things, but I am worried that about what we don't know about the airline industry and how there might be some shakedowns yet to come that might impact Air Lease. Air Lease, when you compare Air Lease's performance to AerCap and the other major leasing companies, Air Lease is just, their return on equity and return on capital is just so much better. Their efficiency is so much better. When they've had airlines go bankrupt in the past, they've been able to turn around those planes. The price of airplane fuel, jet fuel, had been expensive, and it was really driving the move towards modernized fleets for many airlines. With with jet fuel so much lower in price today, less of a demand, but I still think that airlines want the more modern planes in these difficult times. As the pandemic arrived, it was noted, for instance, that Delta was only flying their newer planes and leaving the older planes parked on the tarmac. I think that gives consumers a little more comfort when you're in a new plane. It feels cleaner. It feels less threatening than if you're on one of their older planes where they seemed a little stained, they seemed a little dirty, they seemed a little worn out. That's not the experience that anybody wants right now. So I think there still is demand. Preferred Apartment Communities is the operator primarily of retail, but they've got a good chunk of real estate that's in shopping centers anchored by grocery stores. And in April and May, they collected 100% of the rent from the grocery store tenants. Now, the other retail tenants, that's less. They were collecting less of the rent there. They continue to pay the dividend, but obviously they have that residential real estate is something to worry about. They also own student housing, with many colleges and universities not going back to full classes. That puts that section of their business under threat. And then they also have some commercial real estate. So that mixed bag, but it just makes things really kind of difficult to predict. So we updated the company in the July issue, which is going to be published tonight. And we're just holding that stock for now. Looked at it and said it doesn't make sense. The downside is priced in at this point. Let's see how things are going to go. Evercore is the investment bank capital markets company. Yeah, during recessions, this is what happens. Companies defer. their IPOs, their public offerings, and so that's going to reduce their business load quite a bit. So we'll see when the economy recovers how Evercore turns around. And then finally, Green Sky. Green Sky is the company that offers a platform for making loans to consumers through contractors and home remodelers, for instance, but also increasingly for cosmetic surgery and dental work. That's their new expanded platform. Their business depends on getting capital from bank partners, and there had been questions from some in the market about whether Green Sky was going to be able to retain its bank partners. It seems to be that there's no trouble because Green Sky, these loans are typically made to people with excellent credit scores. The loans are generate returns that are in excess of what the banks can get by making loans, and they don't underwrite loans for people who need cosmetic surgery or dental work. So it's not a market that they're competitive with. So making buckets of capital available to Green Sky is a pretty good business to be in for them. So not worried about that. The market has a different perspective on the company, and the bears tend to win out. Again, did an update in the July issue. My conclusion is it's a hold. The factors that are holding back the price are not as affected by the fundamentals, but they've definitely been hammered. And we'll see how things turn out. The other companies on the right, I think, are suitable for careful buying when you can buy them at the right combination of risk and return, biospecifics technology. Century Communities, again, a little contrarian, and as well as Essent Group, the provider of private mortgage insurance. But as I said, the housing market is strong. Will it continue to be strong? That remains to be seen, but these companies have continued to perform well. NV5 Global, I still would expect to be the beneficiary of government spending in terms of upgrading infrastructure, but their private, some of their private contractor work might fall off in a recession. Owl Rock Capital is sort of a business development company. I like the company. They shot through their net asset value down to the $12, and they were even lower. Their net asset value at the start of the year was close to $15 and some change. And again, the question is, what's the revised net asset value? What's the value of all of the companies that are in their portfolio? And so there's some uncertainty there, but the yield is very high. So and I think the downside at this point seems pretty limited. The companies that they loan capital to are primarily mid-sized companies, and they select them based on their quality metrics. So this is a good portfolio of companies that Owl Rock is involved with. And SS&C Technologies, software company providing software for the financial industry. So of course that is going to be part of any recession recovery. Financial stocks will be thinking long and hard, but much of what SS&C does relates to, for instance, customer servicing. So you still have to send out customer statements every month, trade confirmations, et cetera, benefit statements. So there's a lot that SS&C can still deliver for its customers, and I think over the long term it remains a good opportunity. In addition, here are the companies that we've recommended recently, some of the ones that I think are really interesting right now. As I've sort of pivoted in our approach, staying away from the riskier elements, even though they may be good long-term candidates, but focusing on stocks that have the right combination of the potential for near-term return as well as longer-term performance. And so out of the last few issues of the newsletter, I still think that these are stocks to take a look at. AMN Healthcare Services provides staffing for medical care. Icon is a biotechnology test outsourcing company, so they do testing for other biotech firms, and I think then that there's nothing slowing down about the research that's going on in the pharmaceutical and biotechnology world. Physicians Realty Trust is a real estate investment trust, but their focus is medical facilities. Those are not shutting down. Those are not asking for rent deferrals. Those centers tend to be operating even if they're on a limited basis. And even if some elective surgery has deferred, they still are in a good position, I feel like. So I'm one of the REITs that I like quite a bit. Federal Signal offers pollution treatment, sterilization and equipment for municipalities in terms of cleaning, et cetera. So I think there's opportunities there. Medifast is the company that makes diet and weight loss foods and courses, et cetera, at home, things that you can do at home to exercise, to monitor, to work with a coach, and they've been a very, very positive performer. The July issue of the newsletter will introduce John Bean Technologies, which is a special industrial machinery maker that looks to serve the food processing industry as well as the aircraft and airport businesses. In the food processing side, again, food safety I think is really critical. They offer a lot of robotic and automated solutions that take the processing of meat and poultry and produce all the way through cooking, frying, sealing, serving, et cetera. And they can make systems that do it all automatically without human intervention. So again, as we're thinking about a new health conscious new normal, I think that that kind of technology is going to become a lot more attractive to companies where you don't need people who may or may not be infected. You can automate a lot of this. And so I think that there's some potential there. And Calabo Growers is the avocado company, and they had a terrific quarter all in all, and they've had some interesting turnover at the top, which I think is going to make them a little more innovative in their approach to their business, and avocados are still remain one of the great growth areas. They call it green gold for a reason. And so when you can buy that company at a reasonable price, I think it's an opportunity. So those are some ideas from the newsletter and from the upcoming issue. Just a couple of final thoughts before we wrap it up here. The survey company DataTrek Research did a survey of investors and said, where do you think the S&P 500 will end the year? They did this in mid-June. And as you can see, the results were almost evenly split, with almost a fifth of respondents saying up over 10%, up 5 to 10%, within 5% up or down, so essentially flat, down 5 to 10%, or down more than 10%. And that type of investor uncertainty, I think, pretty much sums up the market. Where do we think the market's going to go? Opinions are all over the map. And if you're focused on the short term, this is really frustrating. There's no sentiment about where the market is heading. I will note that the survey did discover that those respondents who selected up more than 10% from current levels were twice as likely to be fans of President Trump. So there seems to be the only political bias in the survey respondents that they discovered was the most optimistic tended to be those who were all in favor of the president and his policies. But otherwise, everything is up in the air. I don't think that there's a need to make any significant changes to your strategy. I've been thinking in terms of micro adjustments, small pivots, this direction, that direction, looking at opportunities. We do this all the time, maybe subconsciously as investors. If we can't find fast-growing companies that are at reasonable prices. We can decide, well, let's buy somewhat slower-growing companies at great prices, or we decide, well, we'll buy a little bit of this fast-growing company at a higher price. You know, we make adjustments all the time, and so I think, as I've suggested, looking at industries that are going to be a little more resilient for the next half a year, the next year and a half, to get us through to 2021 and beyond, might make it easier for you to sleep at night with your portfolio. We never want to take action out of panic. We never want to try to capitalize on fads and trends. You'll notice I'm not doing research looking for who's making face masks. I happened to look last night. Cloth face masks are now coming out by major apparel companies making designer versions. You can pay $20 for a reusable cloth face mask. For some people, this is a great opportunity to express your individuality while still maintaining proper social distancing protocols. But I don't think there's opportunities in it for us as an investor. When I see the companies that are performing well, that have operations that may be benefiting or are addressing issues that are raised by the pandemic and the recession, I think those are great opportunities for us to look out for. But we're not going in saying, let's find companies that are making who are going to have the vaccine, because there are dozens of companies that are searching for vaccines for COVID-19, and it's not at all clear that that's going to come anytime soon. So before we begin, a couple of questions here. Kirpal asks, do I have the webinar recording of trailing stop loss orders? No, I don't, but we will, maybe we'll put that together for my Monday lunchtime stock club webinar at some point, and we'll make that available to the SmallCap Informer subscribers. We've written about it in the newsletter, so there is some work that we've done on identifying and using TSLOs in your portfolio that we can find for you. George says, how do you evaluate REIT stocks with the SSG? We have another service called the Equity Research Service, which is another subscription tool. It's sort of an advanced tool, testing ground. We look at technicals, we look at ratios, we really dig deep into the fundamentals of companies. And on that website, a couple of months ago, we launched a REIT center that uses funds from operations in place of earnings per share. So we have a screener there, and we export ITK files that you can use in Toolkit or in SSG Plus over on the Better Investing website. So the protocol for analyzing a REIT is that we use funds from operations per share in place of earnings per share throughout the analysis. And this, because of the accounting, what's unique about accounting for real estate investment trusts, allows you to capture the what I consider to be a truer record of the performance of the company. And with that website tool, we're able to generate those SSGs without manually maintaining the data there. All right, well, I think that will wrap it up. I want to thank you for coming out to the subscriber webinar. I encourage you to let me know your feedback. Let me know what you'd like to see. Let me know how useful our stock picks are to your portfolio. We're currently covering around 50 stocks. I feel like that's too many. I don't think that some of the smaller ones are doing anyone any good. So I'm constantly looking for reasons and rationale to kind of pare down the results or the universe that we cover. My fear is that then we'd be covering the same stocks, we'd be re-recommending stocks on a fairly regular basis. We do that right now, but I could try to introduce new companies on a regular basis as well when we can find the opportunities to do so. But that is my only other wholesale change that I'm considering. And again, I've been working on it for 2 years, trying to pare down that list. We're at around 50. Beyond that, I don't want to be adding more new companies to it, to the universe. But again, if you're looking for, be useful for me to know if you're looking for coverage of stocks that we have recommended in the past, or if you're looking for new ideas, or is it a mixture of both, as I sort of assume. I would really enjoy that. Thanks so much for coming out once again. Thanks to Sean and Russell in the back office, and we'll look forward to seeing you at a future webinar. Take care, stay the course, and we'll see you on the other side.